Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner with our January monthly market update. Before I begin, I want to thank our value clients for the trust and confidence that you place in us. The best part of our day is time spent directly serving you. We look forward to a full house this upcoming Wednesday at our quarterly investment forum at Perry's, getting back in the hang of doing these. We look forward to seeing you. If you haven't registered, you still have a couple days to do that. So please do that. You should have received an invitation from us. We'll address markets and kind of what's going on. There are a lot of headlines, as this slide mentions, and we'll kind of unpack a few of those today. First of all, address Monday. What happened. If this chart looks like something that happened over a multi-year period of time, that would be deceiving. This is Monday's trade, January the 24th. We saw a move on the Dow of 1,000 points, down more than 1,000 at one point, and ended up positive. It's the first time ever the Dow has moved down 1,000 and ended the day with a positive return. What's interesting about that is kind of where throughout the trading day, starting at 9 Eastern and ending at 4 Eastern, kind of where the buying and selling came from. You see the retail investor marked here by black and blue as institutional. So you see institutional selling a lot of that late morning and in the early afternoon. And then you saw institutional buying hit the market in the last 30 minutes to an hour of the trading day. The most recent jobs report was lackluster, less than anticipated, only 199,000 jobs added. The unemployment rate did dip down to 3.9%. However, we're still at fewer jobs than we were pre-pandemic overall, and there's still approximately 10 million job openings. So that remains a friction between a very low unemployment rate, but also a number of job openings. We have seen our average hourly pay pick up 4.7, but as we'll talk about in a second, that's really all consumed by inflation that's running at about a 40-year high. With markets volatile as they are today, it's important to keep in context how frequent a correction, which is marked by a 10% or more decline, is in calendar years. There's a lot of data points here, but what this says overall, going back to 1980, that the average decline intra-year is 14%, and yet 32 out of these 42 years were positive. So we've seen on the S&P on a closing day basis a drop of about 8%. Now the NASDAQ has already corrected. On closing, the NASDAQ's down about 13% from all-time highs, but this just speaks to the fact that corrections like we're experiencing now, while never pleasant, are normal. The NASDAQ, as we mentioned, just logged at 66 corrections since 1971. So that's 50 years, 66 corrections. So again, what that says is on average, you get more than one of those per year. And a lot of the stocks that were high flyers during COVID are down dramatically. Again, a lot of data points here, but these are year-to-date numbers. Zoom down 20, DocuSign down 26, even Amazon down 16, Peloton down 23, and this is actually down on a 12-month basis, approximately 80%. So as we talk about inflation, this delta between the inflation rate at 6.8 and the 10-year Treasury, which now has picked up to about 1.8%, is still 5. The last time it's been anywhere close to that in terms of the distance between interest rates and inflation, we have to go back 40 years. So that's something to watch. The Fed will definitely be speaking to that in news this week and throughout the year. If we look at inflation as it's measured today, it's 6.8, but if we look before they changed the methodology in the 80s and further in the 90s, you would see even a higher inflationary rate. So the Fed is likely to start a process of raising interest rates. That'll be something to closely follow this year. What this shows is what the average stock and bond performance was 12 months after the first rate hike. So clearly favoring stocks, but both are up going back to 94 through the end of 21. One of the things that's supporting the market, even though there's a lot of volatility, that kind of helps put in bottoms, are the fact that there's still a record amount of money in cash. That cash today is earning a negative real return. So even though it's down a little bit from peak at 4.8 trillion, we're still looking at over 4.5 trillion that's sitting in cash, earning a negative real rate of return. So how's the consumer doing overall? The consumer drives 70% of the economy. So looking at how they're doing is worth a quick look. This shows debt service ratio in households overall. You saw a peak in Q4 of 07 of 13%. That's now down to 9.1, largely on a reduction of interest rates that's benefited the borrower. And then net worth, we've seen over double over that same period of time. So from a debt service ratio basis and a balance sheet basis, the consumer is faring pretty well. We will be rebalancing to address the changes in the market. We'll have trade notes out about that soon. The goal of rebalancing is to kind of get back to target and overall to position you to have success over the widest range of possible outcomes. We are in a period of heightened volatility, and the quarterly rebalance to advisory account again gets us back to target and lets us invest in themes that we think are opportunistic going forward. So with that in mind, we'll stop. Again, we try to keep these brief so that they keep you informed. If you have any questions about anything addressed in today's monthly market update, please let us know. We hope to see many of you at the forum next week. Until we see you again, stay well and take care.